Imagine you're standing on the dock, right? And you're just watching this massive cargo ship pull into the harbor.
Okay, I'm picturing it.
And this ship is carrying billions of dollars in global freight. But imagine that while the ship is still out on the open ocean, the crew is simultaneously trying to upgrade its engine to a nuclear reactor.
Oh, wow. That sounds, well, incredibly dangerous.
Right. And at the exact same time, they are actively fending off pirates. And, they're literally drag racing their biggest rival.
Well, that is a terrifying, highly chaotic, and yet entirely accurate picture of the corporate restructuring we are looking at today.
Exactly. Welcome to today's exploration. We're opening up a massive stack of sources for you today. We've got Q3 2026 earnings transcripts, financial forecasts from TIKR, Zacks, The Motley Fool, supply chain trend reports, and even retail market sentiment analyses.
It's a really diverse stack of data.
It is. And we are trying to figure out if FedEx Corporation is about to win that drag race or just sink under the weight of its own 50-year history. We're looking at their position right now in the spring of 2026.
Right. And that context is absolutely crucial for you as an observer or an investor, because FedEx is currently undergoing the most consequential structural reorganization it has ever attempted.
So our mission today is to synthesize all these documents down for you into a clear report. We're going to focus on 3 core pillars: building an investment thesis, mapping out the potential risks, and giving you a clear valuation reference.
Because for decades, they operated on a capacity-driven model. The goal was always just to build more facilities, expand more routes, buy more planes.
Just massive physical expansion.
Exactly. But now they are transitioning to a margin-focused, data-intelligent ecosystem. They are fundamentally rewiring how the company works from the inside out.
So let's look at the blueprint for this overhaul, which brings us to our investment thesis. The bull case for FedEx right now basically revolves around a concept Wall Street is calling One FedEx. And it's driven by this massive operational shift called Network 2.0. But before we get into the 2.0 version, I need to understand what was wrong with 1.0. How does a delivery company actually trim billions of dollars without just firing everyone and stopping routes?
Well, to understand the mechanics of the savings, you really have to look at how FedEx was originally built. Historically, FedEx Express, FedEx Ground, and FedEx Services basically operated as completely independent companies.
Wait, really? Like entirely separate?
Completely separate. They had different management, separate sorting facilities, separate fleets. You literally had situations where a FedEx Express truck and a FedEx Ground truck might drive down the exact same residential cul-de-sac on the exact same afternoon.
To deliver 2 different packages to 2 different houses.
Exactly.
That sounds incredibly inefficient. You're paying for gas, insurance, and labor twice for the exact same neighborhood.
It was incredibly inefficient. But, when your goal is just pure expansion and capturing market share, you kind of tolerate that redundancy. But Network 2.0 is the end of that era.
So they're fixing the cul-de-sac problem.
Right. They are merging all of these distinct operations into a single, unified network. And they're using advanced automated sorting and AI routing to take an overnight air package and a 3-day ground package, sort them in the exact same building, and put them on the exact same final mile delivery truck.
Okay, so that cuts the fuel and labor costs for that specific neighborhood essentially in half. That makes perfect sense. But are they actually pulling this off, or is this just, corporate strategy speak?
No, the sources show they are absolutely pulling it off. Through their D-Drive cost reduction program, which started back in fiscal year 2023, FedEx has already achieved a staggering $4 billion in cumulative structural savings.
$4 billion, that's massive.
It is. And as of the end of fiscal year 2025, they had already closed 100 redundant stations and integrated 290 facilities under this new unified model. Yeah, and in those specific optimized markets, they've achieved a 10% reduction in pickup and delivery costs. They're actually targeting another $2 billion in savings by 2027 just from this physical network integration alone.
So they are dramatically streamlining the core business. But there is also a massive strategic divestiture happening right alongside this. On June 1st, 2026, FedEx is officially spinning off its freight division into a standalone publicly traded company under the ticker FDXF.
That's right. The freight division handles less than truckload, or LTL, shipping.
Break that down for me. What mechanically separates less than truckload from what we think of as normal FedEx delivery?
Sure. Think about a mid-sized manufacturer, right? They don't have enough product to fill an entire massive 53-foot semi-trailer.
Right, because that would be full truckload.
Exactly. but they have way too much product to just put it in a cardboard box and ship it via regular parcel delivery. So LTL carriers combine shipments from multiple different companies onto one single truck.
Got it. So it's a totally different setup.
Completely different. It requires a different type of hub-and-spoke infrastructure, different forklifts, different sales models. Everything is specialized.
But if it's a completely different model and it makes money, why spin it off? I mean, why not just keep the revenue in the FedEx family?
It really comes down to how Wall Street values different types of businesses. When you are a massive, sprawling conglomerate, the market often applies what's called a conglomerate discount.
Meaning they penalize you for being too complicated?
Basically, yes. Standalone LTL carriers, companies like Old Dominion, for example, they trade at much higher multiples because their specific business is highly capital efficient and yields great margins. So FedEx management believes that by separating freight, the market will finally price that specific division at a premium.
Which would unlock billions in shareholder value. Which brings us to a really shocking milestone in our statuses. FedEx recently surpassed UPS in market capitalization for the very first time. I mean, UPS has historically been the absolute heavyweight champion of market cap in the shipping space. How did FedEx pull that off while they are in the middle of tearing down their own house?
It's the result of vastly different strategic choices. UPS is actually intentionally shrinking its volume right now. Their domestic package volume was down 10.8% in the fourth quarter.
Wait, a shipping company intentionally shipping fewer packages? That sounds completely counterintuitive.
It does, but they're going through what their CFO calls a bathtub effect. Imagine a graph that dips down into a U shape before rising again.
Okay, so a sharp drop followed by a recovery.
Right. UPS is actively shedding low-margin deliveries, specifically massive volumes of cheap Amazon packages. The revenue drops sharply, that's the sides of the bathtub. But the idea is that once they clear out the unprofitable volume, they will emerge as a smaller but much more profitable company.
But while UPS is taking a bath, FedEx is basically capturing the high ground.
Precisely. FedEx is aggressively leaning into high-margin business-to-business sectors. They aren't trying to deliver, like, toothpaste to a residential porch. They're moving high-value goods.
Like healthcare, right. I saw they hit $9 billion in healthcare-related revenue alone.
Yeah, moving temperature-controlled pharmaceuticals yields a vastly higher margin than moving consumer retail goods. So management's internal vision is working.
And the sources outline a highly specific target for 2029 because of this. They want $98 billion in revenue, an 8% operating margin, and a massive $6 billion in adjusted free cash flow.
Right. But you have to remember, those projections rely on the world playing nice.
And the world rarely plays nice, which is a perfect pivot to our second pillar, the potential risks. Because they're projecting $6 billion in free cash flow by 2029 based on these internal efficiencies. But internal efficiency doesn't mean much if the external global economy just grinds to a halt.
No, it doesn't.
What happens to that $6 billion projection if, say, oil prices spike due to geopolitical conflict?
That is the first major macro threat we really need to look at. The conflict in Iran and the disruption of global trade routes, specifically the Strait of Hormuz, is a massive variable. I mean, a huge percentage of the world's oil flows through that exact choke point.
Now, FedEx management publicly stated in the earnings call that the Middle East represents only a small portion of their overall direct revenue. They also rely heavily on fuel surcharges, which are essentially fees passed on to you, the customer, to protect their profitability when oil prices spike. Doesn't that insulate them?
It acts as a shock absorber, sure, but it isn't a magic shield. Mechanically, a fuel surcharge works when a business absolutely has to ship something regardless of the cost.
Right.
But if oil stays historically high for a sustained period, it causes broad inflation. Consumers stop buying goods, manufacturers slow down production, and overall global trade suppresses. Sustained high oil prices remain a critical threat that could erode volume across the board, no matter how efficient Network 2.0 is.
Yeah, that makes sense. Which brings us to one of the most fascinating wildcards in this entire stack of research, the Great Tariff Refund. Now, I want to pause here for a second because for you listening, these sources get into some highly politically charged territory regarding trade policies and emergency tariffs from the previous administration. And to be absolutely clear, we aren't taking a side or endorsing any political viewpoints here. We're simply unpacking the financial reality of this legal situation as outlined in the court documents.
And strictly looking at the balance sheet, the financial reality is just staggering. On February 20, 2026, the U.S. Supreme Court ruled that emergency tariffs imposed under the International Emergency Economic Powers Act, or IEPA, were illegal.
Wow.
Yeah. Following that ruling, FedEx sued the U.S. government, demanding a full refund of all the IEPA duties they have paid.
We are talking about a scenario where the U.S. Treasury collected an estimated $133 billion from these import taxes overall. How much of that is FedEx actually entitled to?
That is the multi-billion-dollar question, and honestly, it's incredibly murky. When goods are imported, someone has to be designated as the importer of record who physically pays the tariff to customs.
Okay.
Sometimes that's the end customer, sometimes that's the manufacturer, and sometimes it's the logistics provider, like FedEx, acting on their behalf.
So FedEx is basically saying, hey, we physically paid the government this money on behalf of our clients, so the government owes us the refund.
Right, but the Supreme Court struck down the tariffs without explicitly outlining a mechanical framework for how those refunds should be processed. So it's creating massive short-term administrative chaos. FedEx has taken procedural steps to protect their rights, but trying to predict when or even if a massive cash windfall arrives is virtually impossible right now.
So it's a huge potential upside, but it's just completely trapped in legal limbo.
Exactly.
Chaos is definitely the right word there. Let's look at a much more concrete structural threat. I found a statistic in these supply chain reports that absolutely blew my mind. Amazon Logistics is now the top U.S. parcel carrier by volume.
Yeah, the numbers are wild.
In 2025, Amazon delivered 6.7 billion packages. FedEx delivered 3.6 billion. Amazon is nearly doing double their volume.
Mechanically, what Amazon has done is commoditize the business-to-consumer last-mile delivery. They built out their own massive fleet of vans and independent contractors, and they don't actually need to make a profit on the shipping itself.
Wait, they don't need a profit?
No, because the shipping is just a mechanism to drive their retail and cloud computing empires.
Oh, right. It's hard to compete with a logistics company that doesn't actually need its logistics division to turn a profit.
Yeah.
And it isn't just Amazon either. The sources note that agile, tech-native, alternative carriers companies like Jiu-Jitsu and Better Trucks are growing at like 13% annually.
They are. And these startups don't have 50 years of legacy pension plans or massive fleets of aging cargo planes to maintain.
Right, they're lean.
Very lean. They're leveraging localized AI-driven routing to hyper-optimize deliveries in specific urban centers, which chips away at FedEx's market share in dense, profitable zip codes.
So FedEx is facing the behemoth of Amazon on one side and these agile startups on the other. Which leads me back to a major question about their internal strategy. Looking at the retail sentiment tracking in our sources, Reddit investors are actively betting against that freight spinoff we talked about earlier.
Oh yeah, retail is very skeptical.
And honestly, I kind of see their point. If FedEx Freight is such a reliable, profit-generating segment, isn't spinning it off right now a massive mistake? I mean, spinning off your most reliable cash cow while the main parcel business is under this massive Network 2.0 renovation, it feels less like selling a parachute and more like selling the foundation of your house to pay for a new roof.
That is a phenomenal analogy, and it captures the exact tension Wall Street is grappling with right now. Let's look at the numbers. FedEx Freight's operating margins did compress slightly recently, dropping from 15% to 12%, but it still provides incredibly solid, predictable cash flow.
Right.
When you remove that reliable pillar, the main structure, the parcel delivery business, has to stand entirely on its own merits while it's still being rebuilt.
It just seems like an unnecessary risk when you are already dealing with Amazon and Iran in tariff lawsuits.
It perfectly illustrates the high-wire act management is currently performing. They firmly believe that the long-term valuation unlock getting that premium multiple for the standalone freight business is worth the short-term structural risk of losing that revenue stream.
Okay, so we have this intense tug of war. On one hand, you have brilliant internal cost-cutting, merging networks targeting high-margin healthcare logistics. On the other hand, you have terrifying external risks, massive legal ambiguity, and a controversial spinoff. Which brings us to our third pillar, the valuation reference. How is Wall Street actually pricing this transformation right now?
To understand the valuation, we really have to start with the recent Q3 2026 earnings report, because it completely reframed the narrative for investors.
Yeah, the numbers in the transcript were wild. They absolutely crushed it.
They did. Adjusted earnings per share came in at $5.25. The consensus expectation from analysts was only $4.09. That is a massive beat. They generated $24 billion in revenue, which was an 8% year-over-year increase. But crucially, they didn't just beat the past quarter. They raised their full-year fiscal 2026 EPS guidance to a range of $19.30 to $20.10.
So they beat expectations by a mile and then told everyone, hey, expect us to keep beating them. How did the stock multiples react to that kind of confidence?
My instinct is that the stock is getting too expensive for a legacy shipping company. Am I misreading this, or are analysts justifying a premium here?
Your instinct is spot on regarding the price tag. FedEx's price to earnings, or PE ratio, is currently sitting around 19.3x to 19.6x based on trailing earnings. Now, that is noticeably higher than its 5-year average, which hovers around 15.5x.
So on an earnings basis, it is historically expensive.
Yes. But here's the fascinating countermetric. Its price-to-sales ratio is still sitting under 1 at 0.95x.
Let's contextualize that for a listener who doesn't stare at valuation models all day. A price-to-sales ratio under 1 essentially means the market values the entire company at less than the total revenue it brings in over a single year. Right. Exactly. It's a sign that Wall Street is still slightly skeptical about their profit margins. They are viewing FedEx more like a traditional utility or a railroad than a high-growth tech stock. The revenue is massive, but the market wants to see how much of that revenue actually turns into profit.
But the analyst targets suggest they believe the profit is coming, don't they?
Yeah, synthesizing the analyst projections across the board, the consensus is a solid buy. The average price target sits around $385. However, if you look at the more bullish firms in the reports like Bernstein and Barclays, they're targeting $450 to $457.
And the TIKR valuation model goes even higher. Their mid-case target suggests a price of $500.19. But what caught my eye wasn't just the $500 number. It was the mechanism driving that number. The logic is built on the belief that FedEx's free cash flow will actually double by 2029. How do you double cash flow when you already have $98 billion in revenue?
You do it by drastically cutting your capital expenditures. Historically, FedEx had to spend a massive amount of its revenue, upwards of 8.6% every single year, just buying Boeing 777s, paving runways, and building millions of square feet of warehouse space just to keep up with expansion.
Building the capacity model.
Right, but the thesis of Network 2.0 is that the expansion phase is over. Capital expenditures are projected to drop to just 4% of revenue by 2029.
And for you, looking at this as an observer or a potential investor, that drop in capital expenditure is the real aha moment. It means FedEx is finally done buying the real estate and the planes. The heavy infrastructure is built. When you stop spending billions of dollars a year on new physical assets, that money drops straight to the bottom line as free cash flow.
Precisely, and that answers your earlier question about the valuation tug-of-war. The market is looking at the rising PE ratio and deciding to pay the premium. Wall Street is looking at the $4 billion already saved, they're looking at the capex dropping, and they're saying, we believe management can finish the job.
That makes perfect sense.
It makes FedEx a growth-oriented pick today, especially compared to UPS, which is currently viewed by many analysts as a value trap until they can prove their bathtub effect actually leads to a recovery.
Okay, we set out to synthesize all these documents into a clear picture, and here is where we land. FedEx is executing a brutal, incredibly complex, but so far highly effective restructuring to boost their profit margins. They are literally tearing down separate networks to build a unified powerhouse.
Yeah.
And they are doing this while facing down massive global geopolitical risks, unprecedented legal battles over $133 billion in tariffs, and a daily grind against Amazon's sheer volume. And despite all of that risk, they are currently commanding a premium valuation based on a very credible promise of massive future free cash flow.
But before we wrap up, there is one final, entirely unexplored thread hidden deep in these sources that we should leave you to mull over. We spent this entire time talking about FedEx combining its physical networks, the trucks, the warehouses, the planes. But the next evolution of this company is entirely digital.
You're talking about the AI agent deployment.
Yes. According to the technology roadmaps in these reports, FedEx is planning to deploy artificial intelligence agents in more than half of its operational workflows by 2028. This isn't just a routing algorithm. These are systems capable of making autonomous logistical decisions.
This raises a profound question. I mean, if the current transformation is about optimizing the physical path of a cardboard box, what happens to the internal mechanics of the company when you start replacing human dispatchers, route planners, and logistics coordinators with artificial intelligence?
It changes everything. It fundamentally alters the DNA of a company that was quite literally built on the backs of physical labor and human logistics management over the last 50 years.
It really is the ultimate upgrade. To go back to our cargo ship analogy from the beginning, they aren't just installing a nuclear reactor while drag racing UPS, they are installing an AI captain while sailing through a geopolitical hurricane. It's going to be a fascinating voyage to watch unfold. We hope this gave you exactly what you need to be perfectly well informed. Continue to watch for our next release.